Thanks for tuning in to our weekly investment audio cast here at Signature FD that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer here at Signature FD. So, as we've been doing in recent weeks, we're going to start with our chart of the week, in which we title, Are We Looking at Risk Wrong? So, I was going through the JP Morgan Guide to Retirement, and they run some surveys of folks that are in retirement accounts, 401ks and such. And they ask folks here, how would you describe your investment risk tolerance at different points in time? And you can see that darker yellow color is conservative and the lighter yellow color there is moderately conservative. And we can see that starting in the 50s, and especially evident as people and participants start to get into their 60s, you can see that their assessment of their risk appetite really starts to change. And all the way through their 70s and 80s, participants began to get more conservative through time. Very few participants were calling themselves aggressive or even moderately aggressive. It's generally moderate, moderately conservative, and you can see how much conservative grows. And that got me thinking that are we looking at risk the wrong way, especially among our growth assets? So we all know that sequence of return risk is an important thing. When you first retire, a bear market is more detrimental than if a bear market happens later on in retirement. So it does make sense to us that investors should probably think more conservatively in the early stages or perhaps the first decade of their retirement. But then as you get further into your retirement in your 70s, 80s, and you've been able to avoid that catastrophic bear market, your chances of success really start to elevate. And what we find is that clients often end up with excess capital in their 70s and 80s. That is really earmarked for their estate and not necessarily going to be used for their own living goals in their lifetime. And at that point, I think we need to start thinking about what sort of investment mandate makes sense for the next generation's capital. So I really think that we should be considering risk, of course, on a timeline approach, but also where those assets are going to go through time. And if they're legacy assets, then we probably should think about risk on a longer term timeline perspective, and investors might do well to be more aggressive in their allocations. Now, looking at the data from last week and turning to just kind of asset class returns, we can see here in this chart that most major asset classes are up so far year to date. The S&P 500 is about 7.8%. Small cap stocks 1.2%. But one of the things we've been noting consistently is the performance of the international markets. So you can see here that developed international markets, otherwise known as EFA, are up over 19% this year, and emerging markets have really caught up lately, up over 18% year to date. And that is being assisted by a weak dollar tailwind. So we can see that the dollar is actually down over 9% year to date. Regardless, it has thus far been a pretty solid year for market performance, especially out of international stocks. So, looking at some of the economic data that could have been impactful last week, retail sales is something that we watch to kind of judge the health of the consumer. And we can see here in the top clip that year over year, retail sales were up about 4.1%, which is a very solid reading. Now, when we look under the covers a little bit, we see that for the quarter, retail sales only really expanded about 0.5%, and inflation was up 40 basis points itself. So when you compare a 0.5% retail sales growth number to inflation of 0.4%, we can see that retail sales didn't really grow that much net of inflation on the quarter. So that's something that we'll want to be watching. We're also keeping an eye on the housing market. So what we're showing in blue here is home builder sentiment, and that dashed black line is housing starts. And you can see that housing starts do tend to track home builder sentiment. And home builder sentiment is pretty depressed right now, owing to relatively high interest rates and slowing activity of prospective home buyers. So housing affordability has been an issue. We can see that in home builder confidence, and housing starts have started to hook lower. So that's going to be something else to keep an eye on, especially because construction jobs tend to be a pretty good leading indicator of the broad economy. Now, we're starting to see some tariff impacts coming through here from an inflation perspective. So, retail sales, new home starts, and inflation were big numbers to pay attention to last week. We see that inflation was up about 2.7% year over year. That was a little bit of an uptick from the month prior. Still not bad, but higher than the Fed's target goal of 2% inflation. And what's been kind of a fascinating dynamic in this last report is you can really start to see the tariff impacts taking hold. So in blue here, we're showing a CPI for core goods. And in black, we're showing CPI for services, less energy services. So you strip out energy services from that. And we can see that service inflation has been really high the last several years, while goods inflation, goods have actually been deflating over about the last year. Well, now goods inflation has started to hook higher. It's only up 0.7% year over year, but remember, it had been deflating. That is going to be the area that's more tariff impacted. What we can see is that service inflation has been softening. And I think that's really what you see with the net impact on inflation with tariffs. If consumers don't have an infinite money supply to just spend more and more money, they have to make choices. If goods prices are rising, then it makes sense that service prices would soften. So we don't necessarily see tariffs as outright inflationary to the total inflation picture. We rather see it as a tug and a pull between goods and services. If companies continue to pass through their tariffs in the goods space, then there's probably not a lot of room for inflation in the service space. Now, when we turn to earnings, the earnings season here has gotten underway. We've had about 12% of companies in the S&P have reported, about 20% of economy-wide companies have reported, inclusive of small caps and mid caps. What we can see here in that darker blue line, that's the forward earnings progression. We can see that forward earnings have continued to grow, and that's a good condition for stocks. Usually the stock market doesn't tend to get itself into too much trouble as long as earnings are in fact expanding, and that has been the case. Now, the lighter blue line is actually the S&P 500 price. And that's where you can see a real disconnect, where the price has been moving further away from the projected earnings growth. So that is a condition that we're cognizant of. What that tells us is that valuations have gotten more expensive, and that probably limits the upside that we can expect over the next months, maybe even years for the stock market. Now, one thing that has been encouraging is I said about 20% of companies have reported inclusive of small and mid-cap companies. And that's what we're showing here in this chart is we're showing profit margins in the top clip, earnings growth in the second clip, revenue growth in the third clip, and then just the total just net profit margin and the change in net profit margin in the bottom clip. And we can see from this that thus far only 20% of companies have reported, profit margins have actually expanded a little bit. Profit margins are up about 4% over the last year from where they were prior. So that has been a good sign. The degree to which companies are able to protect their margins is going to be important. Now, most of the companies that have reported are in the financial space right now. So we're going to really see how this takes hold in things like the consumer staples sector, consumer discretionary sector, places where there's goods prices that have been subject to more of the tariff burden. Now, turning to some of the technical things that we're seeing out there, I wanted to take a little bit closer look at small caps because they've been an underperformer again this year. And this chart plots the ratio of small cap stocks to large cap stocks. So the way to read this is if the line is going up, that means that small cap stocks are doing better than large cap stocks. And if the line is falling, that means that large cap stocks are doing better than small cap stocks. And we can see that the line has actually been falling since 2011. So this is now the longest time on record of small cap underperformance to large caps. Now, there's a lot that's going on here that's driving that. One, small caps tend to be more sensitive to the capital markets. So when interest rates are higher, that does tend to affect small caps more. They also tend to be more economically sensitive. And since the global financial crisis, the economy has never really clicked on all cylinders. It's been a relatively slow growth economy since the financial crisis. And third, there's just fewer small caps going public now than there used to be. Quality, fast growing small cap companies are staying private for longer and sometimes not even going public at all. Or when they do go public, they're going public as a mid-size or a large size company rather than a small company. So there's a lot of things in play right now that's driving that trend, but this has now been the longest stretch of small cap underperformance on record. Despite that, market breadth is still really solid for large cap stocks, but quite a bit less solid for small cap stocks. So all we're showing in this chart is the percentage of stocks in each of these categories that's above their 200-day moving averages. So that just means, are they in a longer term uptrend or not? And we can see that mid-cap growth companies, 81% of the stocks are in an uptrend. That's a very healthy reading. Large cap growth companies, large cap value companies, those also have really solid readings. Small cap companies, it's been a little more difficult. Only 51% of small cap growth companies are in long-term uptrends, and only 46% of small cap value companies are in long-term uptrends. So the focus for us in portfolio design this year has been more so in the large cap space than the small caps. All right, so to close things out for this week, investors do tend to change their risk perceptions directly in line with their current age. But in certain circumstances, it might make sense to actually increase your risk as you get deeper into your retirement. Now, most major asset classes are positive year to date, and leadership has definitely been evident in the international stocks. Now, retail sales were solid last month, but not spectacular over the past quarter here. We're also watching home builder sentiment for signs of cracks in the economy. Now, the improvement in inflation has stalled here this year, and inflation still remains above the Fed's 2% target. What has been changing is the makeup of inflation is shifting from services to goods as those tariff impacts really begin to become more clear. Now, small caps, we took a little bit deeper of a look in that world for this week. They are on their longest stretch of underperformance on record, but market breadth is healthier for the large caps. So we've been focused more on the large cap stocks in our strategy. As always, I want to thank you for joining us this week and wish you a great week ahead.